The Precious Metals Week in Review, October 2nd, 2015. Brought to you by Precious Metals International. Markets continue to be volatile as fear and uncertainty in the Middle East seemingly escalates on a daily basis. Emerging market economies have become the focal point for mainstream media as China's economic slowdown is beginning to show signs of contagion to other nearby and related economies. The number of Americans filing new claims for unemployment benefits rose by 10,000 claims to a new seasonally adjusted level of 277,000. The previous week's data remained unrevised. Interestingly, the media chose to categorize the significant jump in unemployment claims as modest in the wake of the Federal Reserve's decision not to raise interest rates last week because such a move remained data-dependent. John Challenger, the CEO of Challenger, Gray & Christmas, discussed a recent report his firm released regarding the U.S. labor market on CNBC's Squawk Box this week. Mr. Challenger was discussing the recent spike in layoffs announced in September, saying, "It's interesting that we are beginning to see some big layoff announcements this year. One of the things you start to see as you get near the end of a period of expansion, but before it really turns lower, is you start to see major layoffs occurring, big mega layoffs like we're seeing now." According to the report, year to date, U.S. employers have announced plans to lay off 493,431 workers, 205,759 of those in the third quarter alone, which marks the worst quarter for job cuts since 2009. The non-farm payrolls report, NFP, for the U.S. seemed to stun the markets when released Friday morning. The U.S. economy only created 142,000 jobs in September, and the August and July numbers were both revised downward. Unemployment held steady at 5.1%, but the labor force participation rate remained mired at its lowest level since the late 1970s. Many analysts feel that the true unemployment number is being masked by the low labor force participation rate, since individuals who are not actively looking for work are not counted as among the unemployed. The Dow Jones Industrial Average immediately plunged on the release of the report. The U.S. government managed to pass a stopgap funding bill on Wednesday that averted yet another government shutdown. The so-called continuing resolution funds the government through December 11th. On signing the bill, President Barack Obama said, "The good news is that it looks like the Republicans will just barely avoid shutting down the government for the second time in 2 years. That's a somewhat low bar, but we should celebrate where we can." On Thursday, just a day after the spending extension passed, U.S. Treasury Secretary Jack Lew wrote a letter to lawmakers notifying them that the government would hit its legal debt limit again by November 5th. Mr. Lew said in his letter, "I respectfully urge Congress to take action as soon as possible and raise the debt limit again." Factory orders in the U.S. also took a hit in August, falling by 1.7%, their largest decline in 8 months. The report, released by the Commerce Department this week, showed the largest drop in factory orders since December of 2014. The drop is likely due to a stronger U.S. dollar, which has been putting pressure on exports, especially in the manufacturing sector for the U.S. In China, the official Purchasing Managers Index (PMI) number came in at 49.8, which was higher than last week's Asian Market Flash PMI number, but still marks contraction in the manufacturing sector for China. Caixin Market also released their final reading on the Chinese PMI for September this week, and that came in at a 6.5-year low of 47.2. Just slightly higher than their initial estimate of 47. Any PMI reading below 50 indicates that a manufacturing sector is in contraction. The fact that both the official and unofficial PMI readings indicate further economic contraction for China may mean that Beijing will be forced to implement further monetary stimulus measures soon. In a report released on Wednesday, Barclays analysts noted that global equities are closing in on their worst quarter since 2011, with a number of factors fueling fears in an already jittery market, including weak global growth, driven by deceleration in emerging markets, particularly China. The International Institute of Finance released its own data on Wednesday, showing that emerging markets suffered their worst quarter since 2008, with global investors selling off close to $40 billion worth of assets in emerging markets. International Monetary Fund Managing Director Christine Lagarde also appears to be concerned over the state of emerging market economies, saying on Wednesday, "On the economic front, there is also reason to be concerned. The prospect of rising interest rates in the United States and China's slowdown are contributing to uncertainty and higher market volatility. There has been a sharp deceleration in the growth of global trade, and the rapid drop in commodity prices is posing problems for resource-based economies." In Syria this week, the ongoing civil war escalated as Iranian troops arrived to support President Bashar al-Assad's government, and Russian warplanes allegedly bombed camps of rebels, which had reportedly been trained by the U.S. Central Intelligence Agency, CIA. Moscow claimed that it had hit Islamic State positions, but the areas hit the hardest are known to have been controlled by rebels fighting against Assad's government. Russia's support for Assad puts them at direct odds with the U.S. and other Middle Eastern allies' support of the Syrian rebel faction which desires to oust Assad's regime. Pro-independence parties won a wide majority of seats in Catalonia's parliament following the elections over the weekend, increasing the odds that the region may proceed with its long-standing desire to break away from the rest of Spain. Catalonia's president, Artur Mas, who had said he would resign if the pro-independence parties failed to gain power, said, "Catalans have voted yes to independence. That gives us a great strength and strong legitimacy to keep on with this project. We have won." Crude oil had been driven higher earlier in the week, moving towards $50 a barrel on the seemingly growing tension between the U.S. and Russia over actions in Syria. Friday saw additional weakness in the price of crude following the release of the worse-than-expected non-farm payrolls report in the U.S. The slowing global economy is leading analysts to predict weaker demand for oil, which continues to put downward pressure on prices. A large drop in the weekly U.S. oil rig count released by Baker Hughes late on Friday sent prices moving higher again late in the session. The euro began the week moving lower against the U.S. dollar, but saw a sudden surge higher late on Monday. The euro could not keep the momentum going against the dollar and had dropped back to new lows for the week by Thursday. Friday saw a vertical spike higher following the release of the non-farm payrolls report in the U.S. that will see the euro close the week higher against the U.S. dollar. The Japanese yen began the week moving higher against the U.S. dollar and saw some downdrafts midweek that pushed the yen lower into Friday. The yen also saw a vertical spike higher following the release of the U.S. non-farm payrolls report and will also close the week higher against the U.S. dollar. Volatility should be expected to continue. The release of the much-awaited non-farm payrolls report in the U.S. took everyone by surprise on Friday. Analysts had expected job creation to be in excess of 200,000 again, and instead received news that the U.S. economy only created 142,000 jobs in September, and that the August and July figures were being revised lower as well. The other internal data in the report, such as the labor force participation rate, hourly earnings, and average work week, were all lower as well, perhaps indicating that the U.S. jobs market is not nearly as robust as many had believed. The mainstream media took most of the day trying to figure out how to spin the poor data to make it sound more palatable to investors. The poorer-than-expected jobs report likely means that the much-anticipated interest rate hike from the U.S. Federal Reserve will not make an appearance until late 2016, if then. The Federal Reserve appears to have missed its window to normalize interest rates and now appears to be trapped by a decelerating global economy. A spate of large layoffs announced and/or expected by large companies such as Hewlett-Packard, Walmart, Sprint, and others may soon result in a sizable spike in unemployment claims just ahead of the holiday season in the U.S. Any surge in unemployment claims, along with the escalating geopolitical unease in the Middle East, could have a negative impact on consumer confidence and trigger further cash hoarding by U.S. consumers once again. The U.S. manufacturing sector is already seeing a substantial decrease in profits as a result of lower exports, and an accompanying slowdown in consumer purchasing at home could trigger additional cost-saving measures in that sector as well. In the Middle East, events in Syria escalated as both Russia and Iran waded into the ongoing civil war in the region in support of Syrian President Bashar al-Assad's regime. Iran, who has thus far only supported Assad in the form of advisors, has reportedly sent troops and equipment to the region that would be capable of carrying out a ground offensive. Russia, for its part, carried out multiple airstrikes in Syria this week, which were reported to have targeted rebel positions, not the Islamic State positions Moscow claims to have struck. A strike on Syrian rebel positions would put Russia at direct odds with the U.S. and its other allies' goals to support the Syrian rebels and remove Assad from power. The incident is sparking comparisons between the U.S. and Russia that have not been made since before the end of the Cold War era. On Friday, following what appears to have been a Syrian government airstrike, the United Nations announced that it was suspending delivery of humanitarian aid to the region due to the increase in airstrike activity. In Asia, evidence continues to mount that the economic slowdown in China will continue for the foreseeable future and is now having a noticeable effect on other emerging market economies. In Europe, divisiveness appears to be growing. Catalonia carried out its elections over the weekend, and the victors were the pro-independence parties who wished to see the region secede from the rest of Spain. Madrid is clearly concerned about the risk of a secession by Catalonia, particularly because the Basque region would likely not be far behind Catalonia in making its own bid for independence. The global economy appears to have hit a major obstacle since China began its economic slowdown. The U.S. economy, based on September's jobs and manufacturing data this week, is also clearly not strong enough on its own to lead the required global recovery. In the face of escalating global macroeconomic and geopolitical uncertainty, stock markets appear to be losing steam and becoming more volatile. As it becomes more evident that global uncertainty appears to once again be the new normal, investors appear to be regaining their interest in precious metals as a safe haven play against times of uncertainty. Wise investors have continued to acquire physical precious metals as part of a well-diversified portfolio, as prices have continued to consolidate around current levels and they have been presented with appropriate buying opportunities to do so. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, October 2nd, 2015. Brought to you by Precious Metals International.